Hey everyone, this is Matt with the Fundamental Investing Institute. Welcome to this week's Fundamentals Unfiltered. We are recording this on 9/30/2025. So I should start this show with a discussion of the looming government shutdown, but it is becoming an old song in American politics. It's not really affecting markets as of this morning, so we're just going to see how this plays out. Unless we see this really moving credit and equity markets, there's not a whole lot to say at this moment. So, moving on to some articles in this past week that I thought were very interesting. One in the Wall Street Journal, titled "The Credit Market is Humming," and that has Wall Street on edge. This is talking about the really red hot market for corporate credits, and a couple of things that the article highlights that I thought was interesting. First of all, we had two sudden high profile bankruptcies in the auto sector, and that is kind of shaking things up a little bit. There's a lot of concern over broader debt market fallout, but so far that's not been the case. Now, a couple of metrics here. One is the yield spread, and in this case, we look at the yield spread between investment grade corporate credit and U.S. Treasuries. Now, Treasuries, for all intents and purposes, are still considered risk-free yields. So anything above that represents a risk premium. And that risk premium, or that spread, in September was 0.74%. That's the lowest level since 1998. Think about that. That is the lowest level since 1998. If we go lower on the investment grade in corporates, if we look at non-investment grade debt, or what we call junk bonds, that spread is 2.75%. So that is all investors are getting in terms of risk premium over U.S. Treasuries on the lowest rated corporate debt. 2.75%. That's the lowest spread since 2007. This is a measure I talked about in 2018, 2019. That was making me really nervous about some of the things that were going on in the corporate credit market. These junk bond premiums were just really, really low, and they continue to be low today. Again, lowest level since 2007. The private credit market, which is something that I've talked about in a previous video, that has ballooned to nearly $2 trillion. That's probably the biggest source of concern for a lot of investors, a lot of analysts. So what I specifically talked about, and this article touches on too, is an increasing amount of yield in the private credit markets is being paid in kind. And what that means is that interest is being paid rather with cash payment, it is being paid with additional debt issuance. And you could say, cynically, but I think appropriately, you could say that that is a partial default, right? So that's a bigger and bigger portion of the private credit market that's happening right now. And it's happening at a time when this industry is opening up to retail investors through their 401ks. Hasn't happened yet, but that's in motion. The actual defaults in private credit market in July, according to Fitch, that's a credit rating agency, the actual credit default in private credit market, 9.5% in July. That came down slightly, but it was up to 9.5% in July. So these are big numbers. Something that I thought about too, and I can't say too much about just because I don't know the answer. When rates started to rise in response to inflation a couple of years ago, there was a lot of concern about commercial real estate debt. I mean, there was like $4.5 trillion of commercial real estate debt that was resetting. So this was supposed to be a tsunami of debt that was coming on the market. I haven't really followed up on a lot of that. I need to, and report back, as it were, but it's something to consider. You know, have banks just extended and pretended with all of that debt? You know, just renegotiated terms with the developers. We've had some sporadic instances of some high-profile developers going under, but nothing, nothing huge, nothing that would warrant concern that we had a few years ago. So that's something that I like to dive into a little bit. But the point of this article is that credit markets are being priced to perfection. I would say equity markets as well. S&P, NASDAQ, Dow, even the Russell 2000 is hitting high levels. There are very low risk premiums in markets right now. There's really just not a margin of safety. So if there is some macro shock, be it from a shutdown, be it from whatever, these things really can't be predicted. But the point is, you want to have some buffer when you make investments. And right now, if you're jumping into these markets, you need to do so cautiously, because there's really no margin of safety that can absorb any adverse events. Things are just being kind of priced to perfection. Now, they may be perfect. Things may be very positive. Interest rates may come down. Long-term bond yields may come down. AI may prove to be the productivity enhancer that everyone thinks it is. But there is a lot of optimism in markets right now, and I guess the contrarian in me gets a little nervous. If this article has any merit, then a lot of people in markets are being nervous as well. There was a guest piece in Barron's that I thought was really interesting. This is a guy named Daniel Wiener. I didn't know who he was, but he's a founder of a large wealth management firm. He did a lot of private market investing over his career, I think just with his own capital. And he says a couple of things. He's essentially just sharing this experience because he's talking about this recent executive order, which is going to allow private investments to be offered in 401ks. So there's going to be much more exposure for retail investors. And he talks about his experience. It sounds like about several dozen private investments that he's made over the years. One of the things he highlights is that the IRR, in many cases, that's the internal rate of return. That is a measure of the return on a lot of private equity deals, a lot of real estate deals. I don't think it's a very good rate. I don't think it's a very good measure for reasons that I won't go into here. But nevertheless, Mr. Wiener here suggests that in his experience, a lot of the sponsors who are promising 30% plus IRRs, the actual realized IRRs end up being half or less of that. In many cases, the investments aren't even liquidated at all. So that's something he brings in. He does mention a couple of successful venture capital deals, one in which he made 70 times his money, which is certainly a great return by any case, but it did happen over a longer period of time. And he mentions that most of his other venture capital deals were complete wipeouts. They went to zero. And here he concludes, illiquidity and opacity are big risks that you face with private investments. The biggest risk, however, is that your retirement suffers as a result. So essentially, he's just cautioning retail investors. There is a lot of concern, and there's a lot of concern that, frankly, financial advisors who are intermediating this or advising retail clients may not have a lot of experience in this area. One of the things that I've never really liked about the investment advisory business is that a lot of people who go into that business, they're really getting their education on products from the firms that are actually creating these products. In other words, from the firms whose products they're selling. And I think there's a huge conflict of interest there when these advisors sort of learn from the Fidelities and the BlackRocks. And I think that's probably going to be the case with private investments as well. So it's just an area to be cautious about, but I'm glad to see somebody with experience in this field speaking up about his own experience and the risks. I think that's important as we move forward. So I wanted to do a deep dive. Of course, the big news is the Electronic Arts deal. Electronic Arts is a gaming software company that is being bought out for $55 billion. This is the largest buyout in history. For the record, I owned I have owned Electronic Arts for a few years now. It was really a soft stock. It was doing virtually nothing. I also had some shares in Activision Blizzard a number of years ago. I made those two investments for two reasons. One is it was a thematic play on esports, which looked to me to be growing and had a lot of long-term promise. The second thing is I thought both EA and Activision were buyout targets. Activision was eventually acquired by Microsoft. That was a long and bloody takeover, but it was bought out at about a 45% premium. And EA is now being bought out in similar fashion. The group that's buying it, it's a consortium of three investment funds. One is the Saudi Arabia Public Investment Fund. They're making the biggest equity contribution. The other two partners, Silver Lake Partners and Affinity Partners, are two private equity firms. That consortium in total is putting up $36 billion in equity. Now, what makes this deal so interesting is that $36 billion in equity on a $55 billion total deal value is about 65% equity. That's generally not what you see with leverage buyouts. In fact, it's the exact opposite. With most leverage buyouts, the debt portion represents 2/3 or more of the deal value. The equity portion is the smaller portion. The Saudi Arabia Public Investment Fund is putting up the majority of that equity, of that $36 billion equity portion. They currently own about 10% of the company. So what they're doing is they're rolling over their existing equity into the buyout structure, and then the three investment funds are putting up the remaining equity, and then the $36 billion in equity is coming from that, and then the rest is coming from JP Morgan, which is another interesting facet of the deal, to see a traditional bank doing a big buyout financing. So actually JP Morgan may be the big beneficiary here, because it's sort of highlighting their ability to do leverage deals at a time when, again, the private credit markets are becoming such a larger portion of the total credit market, especially with a lot of these buyout deals. But this is the biggest of all time. Now, I thought it was an interesting thing to talk about, something called risk arbitrage, which is a trading strategy that I've done a little bit. I may do one or two a year, but it's become a pretty competitive area of the market, but there is some money to be made. So the buyout share price, that $55 billion buyout value, breaks down into $210 per share. Okay, so that's $210 per share, not $2. $210 per share. So that's what you are going to receive if you're an EA shareholder. The stock price prior to the announcement, so the last closing price before the announcement was made, before that information got into the stock price, was $168.32. So the takeover premium is about 25%. Okay, that's 25% premium above the pre-announcement trading price. Now, the buyout deal is being done at a very high multiple of EBITDA. If you don't know what that means, EBITDA is earnings before interest, taxes, depreciation, and amortization. And the reason that's used in the buyout world is, number one, it is pre-tax and pre-interest. So when you have a lot of debt, you want to look at things pre-tax, pre-interest. And it is a proxy for the cash flow that's available to service debt in the first few years of the buyout. It's really not a good long-term measure of debt service, but in the first 2 years, it's a measure. So EBITDA is used in the buyout world to look at takeover multiples. This deal is being done at a pretty high multiple. It's 27 times estimated EBITDA. So that's estimated EBITDA for the next 12 months. 27 multiples, pretty high. Now, I'll talk a little bit about something called risk arbitrage. This is the trading strategy. So the closing price yesterday was about $202 per share. Okay? So that's what's called a deal spread or an arbitrage spread is the difference between the closing price per share, or the buyout price per share, which is $210, and the trading price. I'm going to use the trading price as of yesterday, $202. So that's about a 4% deal spread. So if you bought it at $202, held it to the closing date, you'd get about a 4% return. Annualized, that's about a 7% return. And that's not a great profit, but one thing to know about risk arbitrage is the bigger that discount, the more uncertain it is that the deal will close. So what you're being compensated with that discount is A, the time necessary to close, and B, the uncertainty that it will close. It will close at a price at or above the takeover value, and it will close in a reasonable period of time. So there's all this uncertainty that you're being compensated for. This small deal spread is reflective of the fact that this deal is probably going to get done pretty easily. There's not a huge amount of regulatory hurdles. I should say one of the private equity funds, not Silver Lake Partners, what's the other one? Let's see here. Affinity Partners. Affinity Partners is run by Jared Kushner, who's the president's son-in-law, and he seems to be centered to this deal because there is some regulatory stuff that has to be done to bless a mostly foreign financed acquisition. I don't see any, and I don't think the market sees any hiccups in this, which is why the deal spread is so low. But nevertheless, there is a trading opportunity, 7% annualized if you wanted to trade on it. I'm not going to. That's not a real great return, but it is seemingly a low risk return that could be earned by trading that. Now, I want to talk about some things that I'm reading. Last video I did last week, I talked about this book called Primal Intelligence, written by Angus Fletcher, who runs I guess kind of a think tank, or I don't know, a school at Ohio State that studies the way that humans use narratives in their thinking. That's primarily what this book was about. I finished it. It's a great book. In fact, I liked it so much that I bought other titles from the author, and I'm going to be doing a deep dive into this because I think it's important now when we're thinking about frankly, the role that human beings are going to play in this world that is increasingly dominated by AI. I think this idea of narrative intelligence, how human beings use narrative in their thinking and how that differentiates us from computerized algorithms, that's going to become a larger and larger part of our conversation, and especially for investors, because as investors, we're always thinking about how we make decisions. And there's always this concern about, will algorithms just replace the research process? I'm not convinced that's going to be the case. I still think that there's a huge place for qualitative decisions. I think AI is going to become an important adjunct tool. I'm not using it in my investment research myself, but I think it's something that a lot of professional money managers and independent investors and analysts are going to be using to some degree, but I don't think it's going to take over from good qualitative intelligence that good analysts and investors have. And that's really one of the things that is in this book. Again, I'm doing a deep dive with this author and his works and some other works by other authors into this, and I'll probably write some pieces on our blog. That's at fundamentalinvestinginstitute.com. I'll probably write some pieces on that blog when I am further enough in that process to do that. I started this week on another book. It's called The World's Worst Bet. I just started it. Just a couple of chapters into this. The author is a man named David Lynch. He is a global economics correspondent who's worked for a lot of big news agencies like the Financial Times and and Business Week. I think he's at the Washington Post now, but he's had a front row seat to globalization over the last few decades, and I'm really trying to take a more nuanced view, because I think globalization has been a net benefit for most advanced countries, but the dislocations have been very heavily concentrated, and that's very clearly impacted our politics, and I think it's going to impact our politics for the near future, if not longer. And so it's something that I think that I'd like to get a better handle on before I weigh in too much. Certainly, many of the companies that I've invested in over the years have offshored their production. They've offshored IT and services, and certainly there's been a lot of globalization in companies that I've had interest in. But again, I'm trying to take a more nuanced, maybe empathetic look on that, and we're really doing that to try to think about how that's going to determine policy in advanced countries in the next couple of decades. But with that, I hope everyone has a great week. Best of luck in your investing endeavors, and as always, focus on the fundamentals.